Hello everyone, welcome to the class of Introduction to Finance. Today let's talk about Chapter 2, Financial Markets and Institutions. There are basically three main parts in this chapter. The first part is financial markets, the second part is financial institutions, and the last part is stock markets and returns. There are also two other parts in Chapter 2, the capital allocation process and the stock market efficiency. These two are not that important for our quiz, but the capital allocation process might be important for you to help you understand the three parts later. So I will still go through the first part of the capital allocation process, but I won't spend time on the stock market efficiency. So if you're interested in the last topic, you can have a look at it yourself. There are mainly two learning goals in this chapter. The first one is to identify the different types of financial markets and financial institutions and explain how these markets and institutions enhance capital allocation. So this is the first learning goal. Basically, it covers the first two parts of this chapter. Financial markets and financial institutions. There are many different types. You need to know how to differentiate the several different types of markets and institutions, and also explain how this arrangement, how these structures help enhance the capital allocation process. And then the second learning goal is about the stock market. So explain how the stock market operates and list the distinctions between the different types of stock markets. So this one focuses on the stock market alone, and within stock market you also have different types. So this one is trying to explain how the stock market operates, and you also need to know how to distinguish between different types of stock markets. Okay, now let's have a look at the capital allocation process first. So how is capital transferred between savers and borrowers from the supply side to the demand side? There are three ways. The first one is direct transfers of capital. Yeah, this is just directly like from one person to the other. Like I am in need of money, I come to you and ask you whether you can lend me some money. You said, okay, no problem. Then this is an example of direct transfer. Or I want to start a business, I approach you and ask you whether you are interested in investing. Then you say, okay, no problem. Then this is also direct transfer. It's just the first type is through lending or bond, and the second type is through equity. The second way of capital transferring is through investment banks. This is like a corporation wants to become listed, wants to go through IPO. Then he first needs to find an investment bank. The investment bank will try to find appropriate price for the bank to issue its shares in the stock exchange, in the stock market. So that's investment banks. And the last one is financial intermediation or financial intermediaries. These are usually commercial banks. So they, through commercial banks' assets, they do asset transformation. They take deposits from us, and then they issue loans to corporations or households, whoever are in need of money. So these are financial intermediations. Now let's have a look at them together. The first one is direct transfers. You see, from business, usually business are the ones that we consider are in need of money. So this is the demand side, and the right-hand side are savers. These are the supply side. So securities come from business to savers. These can be stocks or bonds. Stocks are in forms of equity, bonds are in forms of liability. Yeah, but both are securities. So savers are investors who have surplus of money. They give the money to business, so dollars come from savers to business, and then business issue securities to savers. So securities come from business to savers. There's no middleman in between. There are only two participants, two parties in this process. So this is direct transfer. The second type is indirect transfers through investment banks. You see, in this process, investment banks are in the middle. Yeah, and then, but investment banks doesn't really do any asset transformation. They just help the process become smoother, or help reduce the transaction cost. But they don't really do anything tangible. In this case, what I mean is that the securities that come from business to investment banks are exactly the same as the securities that come from investment banks to savers. Yeah. So for example, in this case, if it's IPO, the business wants to issue shares, issue equities in the stock market. Then in this case, the security is the company's stock, and then the business sells its shares to investment banks. Investment banks might buy all the shares depending on the arrangement or the contract they signed. It could buy all of the shares or buy part of it. And then when investment bank sells to the savers, it's the same shares that they bought from the company. So nothing has changed. It's the same type of securities. And then in this process, the money goes the opposite way, from savers to investment banks and from investment banks to business. That's why you see this dashed line here. It's like the investment banks, although it sits in the middle, but it doesn't really do much. The money or the securities just flow in and out. The last type, the third type, is indirect transfers through a financial intermediary. So in this case, you see now the financial intermediary has become a black box. So the money, you no longer see these dashed lines. The securities are no longer the same. So in this case, you can understand financial intermediation. You can imagine the financial intermediary as a commercial bank. So between the business and the bank, this is business securities, usually in forms of loans, right? So this is liability, firm's liability, and then the bank's asset. But this is usually corporate loan. And between the financial intermediary and the savers, this is usually deposits, right? Savers are depositors like us. We give our money to the bank, and the bank gives us their securities, which is usually deposits. So you see the money has completely changed, although the security has completely changed. Although the money, if you really trying to look at it, essentially it's the same money, right? We put our $100 in the bank, and then the bank lend out part of it or all of it. So the money is the same, but the $100 we give to the bank is deposit, but the $100 the bank lend out to the business now becomes a loan, right? So although maybe it's the same $100, but you don't directly own you don't directly have the ownership of the liability to the company. In other words, you are not debt holder to the company, even though the $100 is from your deposit, but you have no right for that $100 business loan, right? You can only ask the bank to pay you back your deposit, but you can't ask the business to pay you back the money. So that's the difference. That's indirect transfers through a financial intermediary. And in this case, you see asset transformation. This is what I mean by asset transformation, that the money has changed in terms of size. So deposits are usually small amount, loans are usually relatively bigger amount. In terms of size, in terms of maturity, deposits in many cases have no maturity, right? It's very short, or sometimes it's relatively short maturity compared to loans. So especially demand deposit, you can withdraw it anytime you want. So asset transformation involves size transformation, maturity transformation, risk transformation as well, because deposits are usually very low risk or even risk-free if they are below $250,000 insured by the FDIC. Yeah, but corporate loans are usually risky, depending on how the credit ratings of the company, but they are definitely no longer risk-free, right? So risk transformation, size transformation, maturity transformation, the security the money has completely changed, right? So that's what I mean by asset transformation. That's what financial intermediaries are doing, and this is indirect transfers. So these are the three ways of capital allocation process. In this capital allocation process, no matter which way you go, you always have a supply and a demand, right? The suppliers of capital are usually individuals and institutions with excess funds. These groups are saving money and looking for a rate of return on their investment. They have extra amount of money that they want to invest. Their goal is trying to maximize their profit on it. And then you also have the demand side, or the users of capital. These are individuals and institutions who need to raise funds to finance their investment opportunities. These groups are willing to pay a rate of return on the capital they borrow. They are in need of money, right? So they want to they are willing to pay a price for it. Yeah, usually in the form of rate of return. It can be fixed interest rate, or it can be equity in the way that they promise like future part of the future returns. So this is the demand side. And in a well-functioning economy, capital flows efficiently from those who supply capital to those who demand it, usually with much less financial friction and much less transaction cost. Yeah, so that's the capital allocation process. And what is the market? So now we have finished the capital allocation process. Let's have a look at the financial markets. What is a market? A market in general is a view where goods and services are exchanged. A financial market is a place where individuals and organizations wanting to borrow funds are brought together with those having the surplus of funds. Yeah, so financial market is just a market where people look for funding and look for investment opportunities. These are different types of financial markets. We have 5 different different ways of distinguishing the financial markets. The first one is physical assets versus financial assets. Second one, spot market versus future market. The third one distinguishes between money market and capital market. The fourth one distinguishes between primary market versus secondary market. And then the last one distinguishes public market and private market. In this 5 different ways of distinguishing financial markets, the middle three are these 3 in the middle are kind of more important than the others. But that doesn't mean the others won't appear in the quiz, but it's just these 3 are more important. Yeah, but let's have a look at them one by one. The first one, physical assets versus financial assets. Physical assets are usually those assets that we call tangible or real, something that you can touch, you can feel, right? Such as wheat, real estate, machinery. Those things you can feel its value. You can touch. Well, you could say that money is also tangible, right? You can feel the money, but it's different. The money, especially nowadays, we use a lot of paper note, right? So you do feel the paper, but you don't feel the value behind it, right? For example, I give you 1 Chinese yuan and 1 US dollar. They probably feel the same, or the Chinese yuan might be even larger than the US dollar in terms of the size of the note, but the value behind it is much less, right? So in this case, you don't really feel the value of it. And financial assets are the ones usually are intangible. For example, stocks bonds, mortgages, and derivatives. Yes, in those old days, you do feel they give you like the paper that shows you your ownership, proves your ownership of the stock. So it's like kind of like certificate or something, but that's not physical asset. It's just a proof of your ownership, but it doesn't really show the value, right? So also the same for mortgages. Yes, you probably have signed a contract with the bank when you want to go borrow loans to buy a house. The contract probably is physical, but the loan itself is not physical. That's what we call financial assets. Yeah, so that's the difference between physical assets and financial assets. Here you don't have to be very strict or very accurate whether this one is physical asset or financial asset. We don't usually be that strict on this one, but just you have a basic understanding of these two different types of assets. And then now let's try to distinguish between the spot market and future market. The spot markets are markets where assets are bought or sold for on-the-spot delivery, literally within a few days. Yeah, so for example, you try to buy Apple stock in the stock market. You buy it, you pay the money today, you execute, you send out your order today, and if it succeeds, you pay your money today, and you probably will get your stock either the same day or the next day, or the next working day, right? So it's like everything happens immediately, or at least within a few days if the transaction takes a number of days. But future markets are different. These are markets where participants agree today to buy or sell an asset at some future date. This future date can be a long date, like in a year, or a near future date, maybe like in a week or so. But when you make the transaction, when you sign the contract, when you agree on this business, you already know that this asset is going to, this transaction is going to be delivered or going to be transferred in the future date, not immediately, or not like on the spot, right? So you kind of bear in mind that this thing will happen in the future. That's what we call future markets. So spot market or future market, the key distinguishing is whether the transaction, whether when you make the agreement, the transaction will happen now immediately or at a future date. Yeah, it doesn't take into account of the time that it needs to finish the transaction. It's just whether this transaction happens in the future or now. So that's the difference between spot and future. Spot doesn't mean that this market has a spot. Yeah, it's like has a building. That's not what it meant. It meant that it refers to the transaction, whether it happens on the spot. This slide here shows the derivatives, but I won't spend too much time on it because this thing won't appear in the quiz, and it's kind of a more advanced concept for our class. We don't really study derivatives here, but if you're interested, you can have a look at them. Have a look at it yourself. But I'll skip this slide for now. The second distinguishing of the financial markets are the money market and capital market. This one kind of is quite important. Basically, in our quiz, you are definitely going to see questions asking you whether one of the financial instruments belong to the money market or capital market. So money markets are markets where they trade short-term, highly liquid debt securities with maturities below 1 year. Yeah, this must be short-term because the maturity is below 1 year. And because it's short-term, so it's highly liquid. And it can only be debt securities. It cannot be equity because equities has no maturities. In other words, the maturity is infinity or it's much longer than 1 year, right? So money market are markets where only short-term debt securities are traded, while capital markets are markets where intermediate or long-term debt or corporate stocks are traded. Yeah, so that's the difference here. Well, this is not a hard and fast rule, but in general, short term, whenever we say short term, we mean below 1 year. Whenever we say intermediate term, we meant the maturity is between 1 and 10 years. And if we say it's long term, then it's over 10 years. So that's the rule here, but it's not very accurate. It's just in general. That's what people meant. And you can also kind of tell the difference between these two markets from its name, right? Money means that it's very liquid. It's kind of already a cash, right? So that's why we only use money market to refer to those very liquid assets, has very short-term maturity and only debt securities. But capital is kind of something long-term with long maturities. So that's the difference. So you need to know the difference between the money market and capital market. Now let's have a look at the main instruments in those two markets. This graph here, this figure here shows you the several important financial money market instruments over the past more than 30 years, 4 decades. So you see that there are mainly 4 important money market instruments. The gray one here, right now it's kind of the largest part, is the federal funds and repurchase agreement. Federal funds are the money that like the lending between financial institutions. Yeah, like from Wells Fargo Bank to Bank of America. Those big banks usually lend and borrow from each other, lend to and borrow from each other. And in most cases, it's very short maturity loan. It's like overnight. And why do they borrow overnight loans? It's like they borrow today and they have to pay it back tomorrow. It's mainly for liquidity reasons. Yeah. Big banks have a lot of liquidity. They require very high liquidity because you can imagine they have a lot of depositors, and then at any time there could be many depositors come to ask to withdraw their deposits, so they have to maintain a very high they have to maintain their assets at a very high liquidity level so that they can meet their demand for liquidity at any time. So that's federal funds. And repurchase agreement is also a very common arrangement between big financial institutions. It's a bit like federal funds, but repurchase agreement is like, for example, I'm Wells Fargo. I sell Bank of America some securities, and I promise to buy it back. So repurchase, buy it back at a certain price in a certain future date. So that's repurchase agreement. But why would I want to sell and buy it back? Of course, in this case, I'll buy it back at a higher price so that the price difference here, it serves as the interest, right? And then the future date is kind of the maturity for the loan. So in this case, repurchase agreement is actually, you can look at it as collateralized loan. Yeah. So the loan has its interest, which is the price difference, and has its maturity, which is the difference of the transaction date. And the reason why I want to sell and promise to buy it back is to reduce the risk, right? If I just say I want to borrow money from you, then you might wonder or worry, what if I don't pay you back? But if I sell you securities and yes, I promise to buy it back, but if I don't have the money and I couldn't buy it back, at least you have the securities in your hand that you can sell to mitigate your loss, right? So the purchase agreement is essentially collateralized loan between big financial institutions. And then the dark red area is commercial paper. but its share has been shrinking over the years. In 1990, it has 27%. Now it's only 12%. So these are the short-term notes issued by institutions. Can be corporations, can be financial institutions, but usually short-term bond kind of. So that's commercial papers, and then this white area is U.S. Treasury bills, and its share is quite stable, except around 2000 it's relatively becomes shrinked, but now it's kind of about 28%, below 1/3. So Treasury bill, I guess you all know what it means. All I want to remind you is that Treasury bill, Treasury bond, Treasury note, they are essentially the same thing. They are all issued by the federal government. The difference is their maturities. That's why they all have different names. Whenever we say Treasury bills, we mean the bond issued by the federal government with maturity below 1 year. We call it Treasury bills. That's why they are included in the money market, right? Because money market only trade securities with maturities below 1 year. So Treasury bills all have maturities below 1 year. Yeah. And then the pink area is negotiable CDs. That's certificate of deposit. These things was a financial innovation at its time, like around 70s, to avoid financial regulation, because at that time there was regulation on the deposit interest rate. Banks couldn't promise you high interest rate. There's a cap on how much interest rate, deposit interest rate they can promise you, because authorities were worried that if banks promise too high interest rate, then they are forced to lend out loans at even higher interest rate, right? Because they make money through the difference between the deposit interest rate and loan interest rate. If the deposit interest rate is too high, because banks face that competition, the pressure from competitions to attract deposits, if they all want to compete on the deposit interest rate, then they are forced to issue loans at a higher interest rate. That's not a problem until firms also have their options, right? Firms can, if they want money, they can either issue bond in the bond market, they can borrow from the banks, they can also issue equities in the stock market, right? If banks ask for too high interest rate, then those good, high quality, credit-worthy firms wouldn't want to borrow from banks anymore. Then it's only those high risk firms, those low credit quality firms would continue to borrow from the banks. But those firms may not pay back the loan. And then in this case, you increase the risk in the financial system, and you're basically creating another financial crisis down the road. So that's why at that time, authorities don't want banks to promise too high interest rate, but banks also face the pressure of attract deposit. So what did they decide to do? They issued a certificate of deposit. It is deposit, essentially deposit, but it's also not really deposit because it's certificate of deposit. So it's kind of you can sell your deposit in the market. And this thing is quite flexible because it's usually large amount, so they don't have to keep the deposit interest rate low, because they're not really deposit, right? Because deposits cannot be sold to another person. These are certificate of deposits. You can sell your certificate to another person. So in this case, they avoid the regulation, and they can increase their deposit interest rate. And then basically that's where the CDs come from, certificate of deposit. Their shares also kind of shrinked over the years, but still about like 13%. of the outstanding amount. And then these four are the main for financial instruments in the money market. And then the blue part is or the gray area is bankers' acceptance. These are very similar to commercial paper. The only difference is that bankers' acceptance are guaranteed by banks, so that they are relatively less riskier compared to commercial paper. Commercial papers are issued by the institutions, but it's possible that institutions may not have the money to pay you back. But bankers' acceptance, yes, it's also issued by the institutions, but bank give you guarantee that this one will be paid. Yeah, so that's why it's less riskier, and it also has much less market share. So these are instruments for money market, and then these figures here shows you the instruments for capital market. All you need to know are the names. If I give you a name, you need to tell me immediately whether this is money market instrument or capital market instrument. You don't need to know the shares. You don't need to know the order of the shares because it changes every year. All you need to know is whether this instrument belongs to capital market or money market. So you see in capital market, the biggest share is this pink area. That's corporate stocks, and it has been expanding. Well, not always expanding, but kind of growing over the years. Now it's in 2019, it's about half of the share. That's corporate stocks. And then the second part, this blue area, is the mortgages. You see, in 1990, it was almost, or it was more than a quarter. Now it has shrinked to 14%. So that's mortgages. Mortgages are long-term, right? It's usually 30-year loan. That's why it's capital market instrument. Stocks are also capital market instruments, right? Because they are equities. They don't have maturities. And then the dark gray area is corporate bond. These are usually long-term bond. That's why they are listed here. If it's short-term, then we call them commercial paper. And then this light gray area are treasury securities. These treasury securities are like treasury bond, treasury notes. They are essentially the same thing as treasury bills. It's just as we said before that treasury bills are those ones with maturities below 1 year, and that's why they're called bills. But if it's longer than 1 year, then it's called treasury bond or treasury notes. And then the light pink area is the state and local government bond. And then this even lighter part is the U.S. government agency bond. The state and local government bond, it's easy to understand. The government agency bonds are the bond issued by the government agencies. For example, Freddie Mac, Fannie Mae, those are what we call GSEs, the government-sponsored enterprises. They finance themselves through issuing bond. So that's this part. And then the white area is the consumer loans, including auto loans, credit card, etc. Okay, after the distinguishing between money market and capital market, the next part is distinguishing between the primary market and secondary market. This is also quite important. The primary markets are markets where corporations raise new capital, which means they issue new bond or new shares to attract capital, to attract funding. While the secondary markets are markets where existing, already outstanding securities are traded among investors, which means the corporation who issued the capital no longer get involved in the secondary market. It's just those securities that were already issued are now traded among investors. So that's the difference here. The corporation whose securities are being traded is not involved in the secondary market transaction and thus does not receive funds from such a trade. So in this case, secondary market it's only investors. Yeah, investors who want to make money out of it are get involved in the secondary markets. It can be institutional investors, it can be individual investors, but no corporations who trying to raise new capital are involved in the secondary market. While in the primary market, corporations are always there. Yeah, that's the biggest difference. Just to see whether the corporation who are in need of new capital are involved in the market. If not, then secondary market. If it is, then it's primary market. The next one is next group is public versus private market. Public markets are standardized contracts, are markets where standardized contracts are traded on an organized exchanges. So, for example, the New York Stock Exchange, everything is very standard. When you send out your offer, you just need to kind of state the price and how much you want to buy. Everything else is standard, right? You don't need to state that how you want to buy it, how you're going to pay for it, how long does it need to finish the transaction. Everything is standard. You just need to state the price and quantity. The rest is standardized. Yeah. While private markets, the transactions are negotiated directly between the two parties. Everything is negotiable. How you want to pay it, how long do you finish your payment, the price, the quantity. They might even offer you discount, right? So everything is negotiable. That's private markets. This slide shows you the importance of financial markets. A well-functioning financial markets facilitate the flow of capital from investors to the users of capital. So it kind of facilitates the funding process or the capital allocation process. Markets provide savers with returns on their money invested, which provide them money in the future. And markets provide users of capital with the necessary funds to finance their investment projects. So well-functioning markets promote economic growth. It has been a classic topic in finance that finance and financial development and economic growth, they are kind of reverse causality. Financial development can promote economic growth, and economic growth, on the other hand, can push financial development as well. So they are all very important. Economies with well-developed markets perform better than economies with poorly functioning markets. Yeah, for example, in the US, financing is relatively easy, cheaper, interest rates are relatively low, not in the recent years because of the high inflation, but in general, the transaction cost is low, the financial friction is much less compared to many other economies, especially emerging economies. Yeah, so in this case, it promotes innovation, promotes economic growth. So that was financial markets. Now let's discuss the next part is financial institutions.